PM live from our studio here in New York City. I'm Josh Lipton alongside Madison Mills. This is Yahoo Finance Live. Here's what we're watching this afternoon. We are an hour away from the close on Wall Street. Stocks down across the board here as investor hopes of a rate cut in March start to slip. Better than expected retail sales data showing the economy may still be too hot for a rate cut so soon. We're going to take a closer look at the numbers and break down what it means for your portfolio.
Plus, we got a slate of big interviews from the World Economic Forum in Davos. You're going to hear from Salesforce CEO Mark Benioff on artificial intelligence. He says AI is a human right, but still has a lot of problems.
And a possible new lawsuit in the government's battle against big tech. The target this time, Apple. The Justice Department may file an antitrust lawsuit as soon as March. We have the details ahead.
Let's get you up to speed on the market action. We're looking at red across the screen here. I'm seeing the Nasdaq down almost 0.9%. The S&P not far behind, down about 0.7%. We've also got the Dow Jones Industrial Average down about 0.4%. A lot of that driven by the commentary about where the Fed is going to go. When I was at the New York Stock Exchange this morning, the guys that I talked to over there were saying to me, definitely no chance in June, and obviously we know March, but June felt like the change for me, and that's perhaps what we're seeing in the price action today. Going into some individual names, Boeing, not surprising, still the worst performer in the S&P. Still seeing some of the highlights though, AMD, Nvidia, Palo Alto, and Juniper Networks making up the top performers today. Josh, looking at the Fed swaps market, showing the probability of easing as soon as March dropping to 50%. That was 80% just on Friday.
Yeah, one big economic data point that investors are thinking about today, retail sales, they topped estimates in December, capping a robust 2023 for consumer spending. The strong report prompting economists and retailers alike to wonder whether consumer resilience will continue in the new year. So December retail sales report, Madison, better than expected. Headline sales increased by 0.6%. Sales excluding autos and gasoline, importantly, a 0.6% gain there. Under the hood, the breakdown of the sales, if you just kind of look at the puts and takes here, general merchandise and apparel stores both seeing gains of over 1%. Non-store retailers, so that's mainly internet-only outlets, rising 1.5%. On the other hand, furniture and electronics and appliance stores, they registered declines. Restaurants you saw were flat, but bottom line, holiday selling season was a success there.
It was definitely a success, and that's likely going to factor into the fourth quarter GDP estimates. Having said that, it's getting a little bit harder to blame the consumer resilience on credit. And I got this from Goldman Sachs earlier today. Personal bankruptcy filing rates hovering over multi-decade lows. And that's what we've been talking about, right? Is the consumer using buy now, pay later? And that's how they're fueling this spending. Not so much when you hear stats like that. Also, Josh, I told you yesterday, I love the Fed Beige Book, okay? Majority of the reporting saw little to no change. So it's not moving markets, but I did get a quote from it that I want to call out here, saying that districts noted that increased consumer price sensitivity had forced retailers to narrow their profit margins and to push back in turn on their suppliers' efforts to raise prices. That could be disinflationary, right? If these, I think about a Walmart pushing back on General Mills, for example, saying, hey, you guys are making the cereal too expensive and we're not going to keep up with that moving forward. Could that be a disinflationary signal for the Fed and for consumers who are looking for cheaper cereal?
Yeah, I mean, the report was so interesting to me because you heard different economists talking about how it maybe was having an impact on how the consumer going forward. We've had any number of economists and strategists come on this show, and when you actually look at it in 2024, you know, they saw a consumer that was healthy, that was resilient, that had a very sturdy labor market behind them. You know, job market still, unemployment is sub 4%. Wage growth gains are strong. But they were kind of getting a bit nervous because they talked about dwindling savings and the resumption of student loan payments. But when you see a report like this, does it change some economists' minds about what they see ahead for their friends and neighbors and how they're going to be spending over 2024?
And that's a great point, Josh, on the earnings cycle there as well. When we think about what we've learned in the bank earnings and what that means for the cash that consumers have on hand, when are we going to start to see the cracks coming in from that? But moving forward here, despite calls for caution from policymakers, U.S. investors still betting on 6 rate rate cuts in 2024. But are business leaders just as optimistic? Yahoo Finance's executive editor Brian Sozzi and our own Julie Hyman spoke with folks on the ground in Davos, Switzerland at the World Economic Forum on their rate expectations in the year ahead. Here's what they had to say.
Our team has 4 cuts next year and 4 cuts in 25, and so that gets you down in the 3.25%, 3.5% range. So that will feel quick, but it's less the pace is where it stops out.
Now it's our house view that we will see rate cuts this year, maybe a little less than what the market's expecting right now, and maybe a little later as well, but we'll have to see.
Are you in the camp of 6 rate cuts this year?
Yes, we are. And we're in the camp that they begin in March, which is more aggressive now that it seems like a lot of the market peers are believing.
I think we have a soft landing. Maybe we'll get 3 cuts, something like that. I think the Fed just doesn't know what it's looking for.
Ultimately, the driver of rate cuts, in my view, is what happens to inflation. And the disinflationary trend cutting through the monthly ups and downs, that's still very much intact.
It's very much intact, but those ups and downs that he mentioned are what's driving the markets, at least from my perspective. Josh, I want to look at the VIX because while I was at the stock exchange this morning, the VIX surpassing 15 for the first time since November, hitting 16 at one point. And this is the fear gauge on Wall Street, right? So this tells us that there's a little bit of that concern potentially coming in, questions about what the Fed is going to do next. Also today, the Atlanta Fed's Index of Business Inflation Expectations, that survey coming out, showing that businesses expecting inflation to decrease significantly over the coming year to 2.2% on average. After that, we saw the 2-year yield hitting just over 4.3% and then record highs for the dollar as well. And I point that out because that doesn't make sense. If we're seeing disinflation, if we're hearing the 2% number that the Fed wants to hear, then we shouldn't be seeing investors flock to safety in the dollar and in bonds. So it just paints to this broader picture of confusion that's probably what is leading to a little bit of that movement in volatility in the options market.
Yeah, I thought Jan Hatzius over at Goldman, and congrats to Julie Hyman and Brian Sozzi for bringing us so many heavy hitters from Davos. But Jan Hatzius is basically saying, listen, he's basing it based on where he thinks the trajectory of inflation, what does that look like in 2024? And you've heard any number of our central bankers come out and say, listen, they like the trajectory, they like where it's going, it is moving in the right direction, but it's still got to get back to that Fed's 2% target, and importantly, the sustainability there. That's the key word. Not just getting it back to target, but then maintaining it. And how tough is that last leg going to be? A big question, especially as you see, geopolitics, the Red Sea, any kind of upside risks that can cause to inflation. You have to imagine that's kind of what is keeping Jay Powell up at night, is that risk of inflation rebounding in 2024.
And the data, as he likes to say, right? We got to wait for the data. We heard Waller reiterating that. So we await the data as well, Josh.
All right. Well, we are exactly 2 weeks away here from the Fed's next meeting. Consensus is that it will hold steady, but the optimism over the first rate cut in March is slipping. Markets now at a roughly 57% probability the Fed cuts in March, which is down 10 percentage points from just last week. And our next guest says one risk for the market is keeping rates too high for too long. Joining us now is Kevin Mon, Henny & Walsh Chief Investment Officer. Kevin, it's always great to have you on the show. Thank you for joining us.
My pleasure.
So help us make sense of it, Kevin. So what are your expectations for the Fed in 2024? When do you think they're going to cut, Kevin, and by how much?
Sure. We'll start with what the Fed's expectations are. As it stands right now, according to their most recently released dot plot chart, 3 cuts next year of 75 basis points, another 100 basis points in cuts in 2025, and yet another 75 basis points in cuts in 2026. What I find interesting is that they're forecasting GDP growth to slow to 1.4% next year. They're also forecasting inflation to stay at 2.4%. So if they're going to be cutting interest rates this year, when inflation doesn't come back to their magical 2% target, it tells me they're more concerned about this economic slowdown potentially moving into recessionary territory than they are worried about inflation staying above 2%. Where am I? I'm in that 4 rate cut camp, 25 basis points each, likely not starting until the second half of the year. The Fed needs to see 2 consecutive quarters of a slowing economy before they can feel good about actually cutting interest rates.
But where do investors look for clarity on that? Because I'm not seeing the slowdown, and my sources sources that I've spoken with today who are now reversing their calls on a June cut are saying that they don't see the slowdown either, and they're worried that that's why the Fed is going to have to go higher for longer.
Sure. If you look at the GDP Now estimate, the most recent one from the Atlanta Fed, they're forecasting fourth quarter GDP to slow to 2.4%. Still good growth, but much lower than third quarter, 5.3%. Then looking at the Fed's own projections for GDP, 1.4% this year and staying below 2% all the way through the end of 2026. If that is in fact true, that is an economic slowdown. How does that economic slowdown actually turn to a period of economic growth? The Fed starts cutting interest rates, providing, of course, that inflation continues to moderate. So we're going to have to see the proof of that economic slowdown over these next 3 quarters. But according to the Federal Reserve, it's coming. And it's an intended consequence of all those aggressive rate hikes that they put in place since March of 2022.
And Kevin, should it matter to investors when they start cutting? Does it matter if it's first half or back half?
I'd be very reticent to tell individual investors to try and play the Fed guessing game. I've been doing this for over 3 decades. I don't play the Fed guessing game well, but I think it's fair to say over the next 3 years, interest rates are going to be lower, yields are going to be lower, inflation should be lower, and economic growth should start to moderate. So with that type of outlook in mind, investors should start positioning their portfolios today for what's likely to happen over the next 3 years. Don't think so short term. Don't think about today, this week, or this quarter. Think over the course of the next 3 years to the next decade. And there's tremendous opportunities in both stocks and bonds that haven't participated in the rally that took place last year, which was largely accounted for, of course, by those 7 large cap technology stocks.
So where do we find that opportunity outside the 7? Yeah. The $1 million question, right?
So we've done the research at Hennion & Walsh and Smart Trust, and it suggests that there are 3 sectors that have historically performed best during periods of economic slowdowns: healthcare, consumer staples, and industrials. Notably aerospace and defense, an area where there's going to be significant investment in over the course of the next decade. However, during the second half of the year, when interest rates actually start to decline, you might want to start leaning into areas such as technology and financials, those beaten up areas of the banking system thanks to the fallout from the regional bank collapse in 2023. That's where you want to start positioning as interest rates start to decline. But investors would be wise to, once again, not try and time the market. That's an exercise in futility. Stay in the market, give yourself downside protection, and lean into those areas of market that should provide for growth. If you're looking for income, look at investment-grade municipal bonds, preferred securities. Extend duration now. As interest rates come down on the short end of the curve, the opportunities become on the long end of the curve. Start positioning now for that likelihood.
And Kevin, I'm just interested as a strategist, as a professional investor, how you think about geopolitical risk, and particularly, the Iran-Hamas war. It's obviously spread. You see Hezbollah, you see the Houthis really having this tremendous effect in the Red Sea, effectively upending international commerce. To what extent, how do you think about that as a strategist? And do you see kind of upside risk of that geopolitical conflict in terms of inflation?
Sure, that's the other big risk that I see for 2024. Not only does the Fed stay too high for too long, but do certain of these geopolitical risks continue to escalate and pull in other countries throughout the world? What type of disruptions do they have in the supply chain? Are they actually inflationary in nature? Tremendous risks that are in place, and there's going to be more volatility in 2024 as a result than there was in 2023. And then, of course, there's a pretty big presidential election coming up with some big economic consequences as well, which could add only more volatility to the equation. So investors would be wise, once again, to work with their financial advisors, make sure their portfolios give them the downside protection that they're looking for, staying true to their risk tolerance, but also trying to meet their growth and their income objectives.
I never thought that we would be just tacking on the presidential election at the end of the risk
that's
conversation.
Happening too.
That whole elephant in the room, but here we are. Kevin, thank you so much. Appreciate it. We're going to have you stick around for our Goodbye segment coming up in a little bit. For now, though, we're going to get a look on our trending tickers. We got about 45 minutes left in today's trade. I want to look at Charles Schwab, though. Those shares still in the red after the company had its worst trading open since March of 2023. Now, this came despite beating earnings, but revenue just missed analyst expectations. And to me, Josh, this is a story about how rate hikes are still impacting banks. Now, the CEO saying that 2023 was the most challenging year for Schwab since the dot-com bubble. Net new assets falling by 48%, deposits down by 21%. 1%. Now, an interesting quote that I want to pull out from the CEO. He said that no one at Schwab is kidding themselves that everything is perfect here. They know that this is a challenging environment, particularly coming off of these interest rate hikes, hurting their own investments, increasing their own debt, while consumers, meantime, see the rate hikes as an opportunity to get returns on a high yield savings account, maybe to go into bonds like our last guest Kevin was saying, and that's hurting those deposits.
Yeah, I mean, it's been a rocky time for Schwab. I mean, you remember, of course, got caught up in the regional banking turbulence. You had folks, as you noted, kind of pulling deposits, kind of hunting for those higher yields. So it was a rough 2023. As you mentioned in this report, Q4, you saw net new assets, looks like fell 48%. Bank deposits dropped 21%. The stock is now down about 25% over the past year. Now, maybe that does price in a lot of bad news because most on the street, Madison, think it is a buy here at these levels.
That's interesting to note. I wonder what the analyst recommendation mix looks like there, but it could be one of those situations where now this name is trading at a discount given that it's at those lows, Josh.
It's been clobbered. Yep. Moving on to another name that's been hit. Shares of Alibaba, other Chinese stocks down today on that weak GDP reading. So this is, listen, we can talk about Alibaba, but this is a broader story than just that name. It's really about kind of U.S. listed Chinese stocks. So yes, Baba, I mean, it's now down about 40% in the past 12 months. If you look at the Crane Shares China Internet Fund, that's down about 30% in the past 12 months as investors have questions about the Chinese economy. A lot of people were betting on a post-COVID boom there. That didn't work out. It's shaky over there.
It didn't work out, and it doesn't appear to have any help moving forward. The government has said, and China's highest-ranking government official since the 2017 visit of Xi Jinping to Davos was there today talking about this. He said that they are not going to be pushing for more stimulus, and that is what the street is looking for to boost that consumer demand, which is what we're going to have to see, particularly when 2/3 of the Chinese economy of consumers right now is tied up in the property sector. That's not going to leave them with a lot of extra spending in terms of the consumer output of what we're going to see impacting a company here like Alibaba. It's really a perfect storm for deflation in China when you think about the birth declines, the aging population, and just the GDP deflating as well over there.
Yeah, and by the way, the Chinese officials, you're referencing making comments in Davos. Remember, those comments coming after China's central bank earlier this week held a key interest rate unchanged. And so perhaps that caused some disappointment for some investors as well who were hoping for bigger action from Chinese authorities.
We're going to do a hard pivot here over to Instacart. Instacart is higher today after an analyst at Wolfe Research suggested that the grocery delivery company could be a takeover target for Uber. Wolfe also upgraded the stock to outperform from pure perform and established a $35 price target. Instacart has been one of these names to watch. We've been looking for who might gobble up this name for quite some time. It's interesting to me that they call out Uber as a potential buyer here, just because we just saw Uber kind of I almost said disinflating. I'm on the Fed chats here. Disembarking from its partnership with Drizzly yesterday, maybe perhaps giving themselves a little bit more flexibility on the balance sheet to look into other investments like an Instacart. But Josh, we know this. Analysts like Uber because they have the capital to invest in other growth areas. And Instacart, I don't know about you, but in my home, it's certainly a growth area.
Is it really? No, we were big Instacart during the pandemic for sure. Like by the way, a lot of people.
And you're saying now I'm
not
lazy.
as much.
Yeah.
No, not at all. I would never make that kind of call, Madison. At least not on air.
Appreciate it.
This is an interesting note. They go to outperform, so a buy. Their price target's 35, and one reason is they do see this potential merger. You might ask yourself, why would Instacart be interested in that? And at least at Wolfe, their argument is, listen, if you're Instacart, you've got competition, plenty of it, and it's increasing from Dash and Amazon and Uber. So I guess the idea is, why not join forces? Why it might not happen, though, there's different reasons for that. The Wolfe team pointing out plenty of risks that kind of M&As generally bring to the mobility space, including, as you mentioned, the fact that Uber just announced plans to shut down Drizzly after acquiring it in 2021. But interesting thesis for sure.
Interesting thesis, and interesting to see what Uber is going to be looking at moving forward. We are just getting started here on Yahoo Finance Live. Coming up, Yahoo Finance is at the 2024 World Economic Forum in Davos this week. Brian Sozzi sat down with Salesforce CEO Mark Benioff about the future of AI. That conversation on the other side of this break.
All right, lots of talk about all things AI and the future of AI here at the World Economic Forum in Davos, Switzerland. Let me just get right to really I would say a foremost thinker in all things AI. That is Salesforce co-founder and CEO, Mark Benioff. Mark, it's just nice to see you. Thanks for making time for us.
Brian, it's always great to be with you.
Yeah, it's great.
All over the world.
Yeah, seriously, we were at Dreamforce. Felt like yesterday, so thank you. Has anything surprised you about the AI talk here at Davos, or at this point, you've just seen and done it all?
Well, there's basically, you have AI technologists here at Davos who've got all their whiz bang, great new party tricks, things they can do. Take a look at this. It's like, David Blaine type, you know what I mean? Like, look at this.
I don't even know how to use some of this stuff.
Yeah, like it's amazing. And then you have CEOs, and CEOs are like, listen, we want to know, what about margin? Mm-hmm. What about productivity? What about higher value customer relationships? Mm-hmm. And that idea and how do those two things come together, that's kind of the conversation that's really happening here. And I'm trying to tell stories and explain to customers what we're seeing with AI. And I think that as we have been kind of traveling around, we see so many exciting opportunities with AI that customers are going to get much higher margins.
Last year at Davos, AI was still a little bit on the fringes. Not for you. I mean, you're seeing these things many years in advance. This year, I'm sensing like deeper things happening with AI. What have you been seeing? Like, what's the next iteration of all this?
Well, we've been building our Einstein platform for a decade. You know that. Yep. We've talked about Einstein dozens and dozens of times. This week, Einstein will do 1 trillion transactions, wow, which is predictive, and generative transactions now, which is really cool. And customers are using it. I just was in Milan with Gucci, and very, part of the Caring Group, incredible company, and they're like, hey, we want to use AI in our call center. And it's like, wait, what do they really want to do here? Is this about, augmentation? Is it about replacement? Is it what are we looking at? And what was cool was we brought in generative AI into our Service Cloud. We're the #1 customer service call center, contact center product in the world, as you know. Mm-hmm. And these agents are using it. And we are running this program for now a few months, okay? And they said something amazing has happened. And I said, what? And they go, #1, revenue's up 30%. I said, wow, that's amazing. Good. That's good. Now, this is a center that in Milan, you buy a product, Gucci product, all over the world, and it's not something's wrong with it or you need it changed and so forth. They help resolve that issue for you. It's about 300 people. It's a great group of people, incredible. And they found that by using AI, their employees started to become more augmented, better. Service agents could start to sell and to market. That is really cool, that all of a sudden that these Gucci call center agents are Gucci sales agents, Gucci everything agents. And the AI gave them the information, the capability, the workflow to be able to do all kinds of amazing new things. That's an exciting story.
When you're in that Gucci call center, when you leave there, do you think, man, maybe I won't see that employee next time because of AI? Where is your head after a visit such like that?
There's no question that where AI is going is digital employees, digital salespeople, digital service people, digital market, digital people.
Yeah.
That idea that we're going to have people like me and you, and there's going to be digital people. Maybe one day I'm going to walk into the Yahoo room and I'm going to be interviewed by the AI instead of Brian. Listen, I don't know.
I need to make it to my retirement, Mark. I'm not there yet.
Brian,
okay.
Here's the point.
Okay, go.
That's not true today.
Okay.
So in today's world, that's not where AI is. We know that AI's got a lot of problems still, like it lies,
Well, hallucinations, you gave me that term. I never heard of hallucinations.
It's hallucinating, it's lying, it's built on stolen data, it's, there's all kinds of problems with AI still. So those issues need to kind of get worked out over time. But we've all seen the science fiction movies, we know where AI can go. But right now, AI can really, make people a lot better. And you know that I'm a huge Disney fanboy, and this year I've been to Disneyland 4 times, okay? And every time I'm there, and I work with Disney all over the company, and if you go to the Disney store online, that's Salesforce, and you talk to the call center at Disney Plus, that's Salesforce. And if you go to Disneyland, and you are, you hire one of those Disney guides, those are the people to kind of help you get through the park a little faster. It was like invented by Walt Disney, it's like the coolest product. for years I've worked with them, and now you'll see they're carrying a telephone with them, you know, and if you look down at the phone, you'll see, oh, wait, Brian says it. The whole system of record, everything is Salesforce, and Slack. They're all talking to all the other Disney guides, collaborating, and they're all better because of Einstein and AI is augmenting them.
That's wild for you, Mark, as a co-founder. I think back 10 years where the company was, now 10 years forward today, to see that type of technology?
Well, it's completely cool. And I have a vision that, you know, my dream is one day I walk into the park and I've opted in somehow and I've said I want to be part of this idea, but I was watching The Mandalorian last night on Disney Plus, and as I walk into the park, Anaheim or Tokyo or Euro or wherever it is, and the Mandalorian walks up to me and says, "Hey, Mark, how did you like that last night?" And that's when I'm like,
that's so weird.
Home run, finally,
we made
making the connection. And I think for some people that's going to be a little spooky, and then for me it's going to be very kind of cool because I actually understand the data parts of it, and I think that that's a great opportunity for Disney. That'll be a next level of the Disney parks.
I didn't know how to phrase this. So how concerned are you about a world of digital people? Like, to me, it is spooky.
Well, I think there's a lot of different ways to think about it, and you know, one of the I pay a lot of attention to my health. I think you know that, and so I get a CT scan of my heart. It's called the CTA scan. I've had like 3 over 15 years, so they look inside your heart and how is it doing. And you know, 15 years ago, I went to LA to this great scanning center, met with this person who invented the calcium scoring. He did it. He's like, "Oh, you're fine. Come back 5 years. Go, here it is. We're going to watch this. You know, you're older now." You know, and then I did it a couple years ago, and they're like, "Yes, you're doing great still. We're still watching that. Great." Then this year, they took that same CTA scan, and they're able to put it into an AI.
Wild.
And then the AI said the same thing. And why that's exciting is, yes, I can go to LA and meet with the guy who invented calcium scoring. Incredible person. But think about all the people in the world who have access to a CT scanner. You know, we just saw the CEO Siemens here. It's a great customer of Salesforce outside. And that idea that now there's a CT scanner, there's somebody who needs to have a scan, and you don't need the very top person in the world. You have somebody who can be there, a radiologist, in concert with this AI, and you can have this analysis. It's not perfect, it's not a replacement, but for sure it's a democratization. There's an equanimity that comes from having that capability. And I think that is the way to start to really think about that. Again, it's an augmentation story, but it's a very exciting story for the future.
Ahead of this conference, Mark, and I hate name dropping, especially in front of you, but nonetheless, I talked to the head of the IMF, and she was making a point that
Kristalina.
Yes, AI.
Right. I love her. She's one of my favorite people in the world.
Awesome.
Yeah,
great thought leader. But she was making the case that AI is going to spread and create more global inequality. Do you agree with that?
Well, there's no question it could. You know, I've actually been saying that for decades, that AI could be, you know, a creator of inequality. It could also be a creator of equality. You know, I think AI has to be almost a human right to have access to AI, and we need the governance around AI. Listen, we're coming into a really critical year on elections, and we all understand social media and what social media can be like, and what can happen with social media and how it can go really wrong. And the reality is, over the last decade, social media has been kind of show.
Yeah, no.
And we've
no
had a
regulation.
lot of talks about that.
Nothing. No regulation. Do you think they'll
How many times have we talked about that?
A lot. It's been you've been consistent. They have done a disastrous job on this. Will they do a better job on
And we
AI?
don't look at Section 230. We don't look at anything. So now we're coming into AI. I think we just were at this UK Safety Summit, and I was very impressed that every regulator from every major country in the world was all there, and that they are really looking at, you know, how are they going to really look at AI and make sure that it stays on the rails? Maybe because they've seen the movies, you know, so they understand where it can go, you know. But I think that this is a really critical moment that these regulators need to step up and to really take this very seriously, because this is real.
That was Salesforce co-founder and CEO Mark Benioff, along with our very own Brian Sozzi. Head on over to yahoofinance.com for more of their wide-ranging interview. And coming up next, we're going to get an analyst insight to break down two stocks and help you make the best choices for your portfolio. It's the newest edition of our series, Goodbye or Goodbye. Stay tuned. It is a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise, to navigate the best moves for your portfolio. And today, we're going to take a deeper dive into the aerospace and defense industry as more government funding is made available and, of course, geopolitical events persist. What is the best way to play it now? I'm here with Kevin Mon, CIO of Hennon and Walsh Asset Management. Kevin, it is great to see you.
It's great to be here.
I want to start, Kevin, with maybe get a look at the Fed's outlook for U.S. GDP. Now, that's what they're seeing, Kevin, but I'm more interested to get Kevin's look. You know, how do you see the U.S. economy, Kevin, kind of unfolding here in 2024? Are you in the soft landing camp, the downturn camp? Where are you?
Sure. The long-awaited economic slowdown is finally coming to fruition, and I think the Fed's own projections here bear that out. If you look at 2024, the Fed has projected that GDP is going to slow to 1.4% and then stay below 2% all the way through the end of the year. Now, that's a slowdown, and that should be a relatively soft landing. What could take that soft landing into an economic recession is if they keep rates too high for too long. I don't think they will. I think they're going to start cutting interest rates towards the second half of this year and keep that slowdown from coming into a recession. So yes, I'm in the soft landing cap for now, but an economic slowdown is coming, and investors will be wise to position their portfolios into areas such as healthcare, consumer staples, and industrial industrials, notably the aerospace and defense sector.
Yeah, let's dig into that. So that's the backdrop. Now let's talk about where you see buys. Sure. One name, and I think our viewers are going to recognize this one. This is Northrop Grumman. You believe, Kevin, this one is a buy here. It's one people should commit capital to. Let's go some of the reasons for this. First one you have, Kevin, here, in terms of your bullets of why you think this one's to own. May gain from defense spending. Talk about that with us.
Absolutely. Over the course of the next decade, defense spending in our country is projected to increase from roughly $783 billion to $1.2 trillion. That's nearly a 50% increase over the next decade. We also know that since 1960, as a percentage of our GDP, military spending has decreased every single year. Gone up in dollar terms, gone down as a percentage of GDP. So we need to increase defense spending, which has only been further drained by us helping out, necessarily so, other countries across the globe over the last 2 years and likely in the year ahead. So who's going to be the primary benefactor of this increase in defense spending? One such name is Northrop Grumman.
All right, second bullet point there, strong stock performance.
Absolutely. Up just over 2% year to date over the last 3 years, annualizing out to about 19% per annum. That's pretty good, especially for a defensive defense name.
And finally here, final bullet point, strong balance sheet pays a dividend. So strong balance sheet and you like the capital return.
Absolutely. So it's got a dividend yield of around 1.5%. And here's the statistic for all the viewers to look at. It's called the Altman Z-score. It was pioneered by an NYU professor right around the corner from here back in 1968. And it helps to predict the probability of a company declaring bankruptcy over the next 2 years. So those companies with an Altman Z-score of 3 or better are less likely to declare bankruptcy. Those with 3 or below are more likely. Guess what? Their Altman Z-score, 4.2. Strong balance sheets, pays a dividend, likely be a benefactor of increased defense spending, and their stock's been doing pretty well.
All right, Kevin, so you've made a very strong case here. Before our viewers decide they're going to go all in, commit capital to Northrop Grumman, talk about some of the risks they should consider.
Certainly. This is a presidential election year. We don't know who ultimately is going to be running for president, much less likely to occupy the Oval Office over the course of the next 4 years, or who's going to be in control of Congress. What if that forecast increase in defense spending doesn't come to fruition? That's certainly a risk for this type of outlook.
And one last question before we move on. Northrop Grumman is a buy. What about some of the peers? Lockheed Martin, is that also another name you like?
Absolutely, Josh. Lockheed Martin is another name that we like and we hold within one of our portfolios at Smart Trust. Has a little bit more of an attractive dividend yield of roughly 2.6%. The exact same Altman Z-score of 4.2, but also traded at an attractive valuation with a PE of around 16 right now.
All right, so we got the name you like. Let's move on. Which name you don't like, Kevin? Another one, I think, by the way, viewers are going to be very well aware of, Virgin Galactic. Let's go through some of the reasons here. First one, unlikely to gain from defense spending.
I can't imagine any of these forecasted increases in defense or military spending going towards individual manned spacecrafts. This is obviously no disrespect to Sir Richard Branson. It's in the aerospace and defense sector, but it really isn't a defense name. It's an aerospace name, and it's a luxury item, not a staple item.
All right, second reason here. Now, the stock is struggling, and struggling is putting it kindly here,
Absolutely.
right? I mean, this stock has been hammered, right? Kevin, it's down about 65% in the past 12 months. That's another reason you're saying to avoid it. You don't think all the bad news is priced in here?
I think there's even more downside from here. Down 20% year to date over the last 3 years. It's down around 59% per annum over that time period. I just don't see the outlook for this getting better, especially if we're going into that economic slowdown period that we spoke about earlier. What individuals are going to pay the money to actually fly to space? There's a very low likelihood of that. And we'll get to the other reasons why I think this company is going to struggle, but certainly this space is an area, pun intended, that's not going to get a lot of attention.
And this one, the third reason, basically you're saying this is the polar opposite of Northrop Grumman.
Absolutely. Yeah. Negative earnings. Their Altman Z-score is negative, so there is a high likelihood of this company declaring bankruptcy over the next 2 years, at least according to that statistic. They don't pay a dividend, and it's just tough to imagine them growing their balance sheet, growing their earning in the likelihood of a slowing economy that's forecasted over the next 3 years.
All right, and let's end here, Kevin. So before you decide to avoid this name altogether, your point being, all right, we're not getting a lot of cooperation here on the tech side. It's okay. We've got Kevin here to walk us through it.
No problem.
what are some upside risks here? In other words, what would turn you bullish on this name?
Sure.
There we go. Now we got it.
The company is still bullish that they can actually launch the Delta spacecraft, and they forecast that they could potentially be cash flow even by the end of 2026. Time will tell. Those forecasts seem to be coming from outer space to me. So this is a name that I put in the good buy category, not the good buy category.
All right, so let's sum this up here for the viewers paying attention. So you're telling investors buy Northrop Grumman due to its healthy balance sheet, strong performance, the potential to take a slice of that government defense spending. On the flip side, though, Kevin is saying avoid Virgin Galactic, as it is not likely to receive any of that funding, the lack of dividend, and its poor performance over the last few years. Thank you to Kevin Mon. Thank you so much for joining us, Kevin. And goodbye. We're going to be bringing you new episodes 3 times a week right here, 3:30 p.m. Eastern.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Really a fascinating new piece of research out of the Nasdaq on the state of the world's financial system, notably what is happening with financial fraud and various other activities. Let's get right to Nasdaq President and CEO Adena Friedman. Adena, nice to see you in Davos. We normally see you in New York. Good to see you here.
Yeah, it's great to be here.
I was going through this report and I was shocked by some of the findings that your team put together here. What is the prevalence of financial fraud right now globally?
Yeah, well, if you look at the problem that we're dealing with money laundering and financial fraud. And it is a $3 trillion problem in terms of money that's laundered through the system, and about a $500 billion issue with fraud. Those are just staggering statistics. And then what we did was we broke it down into different types of money laundering activities, whether that's human trafficking or terrorism activity. And then in fraud, you look at things like romance scams versus elderly abuse. And so you see these different human tragedies kind of playing out in the data. And that's one of the things that we try to do is bring the data and the analytics as to how big this problem was, what are the banks doing to try to fix it, how are they managing to work on this problem together and with the public sector, but also what is the human toll that these crimes take. And so we do have some stories of people who were victims of these crimes, and so to understand the impact it had on their lives as well.
So when the problem is that big, how do you get your arms around it?
Yeah, that I think is the biggest issue, right? It's such an enormous problem, and it's a completely global problem. And when you think about criminals, they don't just bank in one bank. They bank across the entire system. So a single bank, a single institution cannot solve this problem. And law enforcement alone can't solve it either. So it has to be a public-private partnership. It has to be that the banks work together. They share information so that they can actually tackle the problem together, and that they also work very closely with law enforcement. Some of those things are happening today, but a lot could be strengthened to make it, to make the problem, not necessarily, it's going to be hard to make it go away, but to contain the problem a lot better than we can today requires really collective action.
Is technology a main driver of it?
Yeah, I think technology is the great unlock. When you think about it. So one of the things we really focus on is what is the patterns of behavior that criminals tend to act on. So what do they actually do in the financial system? How do they use different account openings, closings, passing money through? How do they behave? So if you can really start to look at, we call it that kind of the typologies of the criminal behavior, and then you use automation, AI, in order to be able to root out that behavior across the system. The first thing you have to do is bring all the data together. So all the data across millions and millions of transactions. Nasdaq today, with our Verifin platform, we see $6 trillion of assets. That's how large the banks, we have 2,500 banks. They represent about $6 trillion. And so we see all their transaction data. You then apply those AI algorithms against these very specific typologies of behavior. It allows you to solve the problem much more effectively. But the United States allows for data sharing, but other countries don't. And so that is where I really feel like, the regulators are really tying the banks' hands behind their back and trying to solve this problem because they can't actually share data with each other to help find the criminals.
What role does crypto play in the financial fraud that you're seeing?
I would say this way, payments are payments. And I think the faster the payment, the faster the systems have to be in order to be able to protect the system. And also the fact that cryptocurrencies are like, once you make a transaction in cryptocurrency, it's immutable. So meaning it's done, you can't retract it. Banks can, with wire fraud or with ACH fraud, they can kind of manage with them themselves to almost back out of, if they think that a bad wire has gone through, they can try to retract the wire. That is not the case with crypto. But generally speaking, payments are payments. So we have to look at regulation, we have to look at solving this problem of financial crime in the same way. Same technologies, same capabilities, but at a faster speed and with more precision because of the fact that it's an immutable outcome.
Does the speed around this fraud just pick up now in light of what we saw with Bitcoin spot ETFs? Does this become more just ever present in our system?
I don't think spot ETFs for Bitcoin necessarily is going to create any sort of new challenges. I think what that's saying is really more that the evolution of the crypto markets, and particularly the Bitcoin market, is such that the underlying price formation is to the level that the SEC is willing to allow retail investors to invest in a security that's a layer on top of Bitcoin, right? They don't actually have to invest in Bitcoin itself. They can invest in a security that's in a regulated market that allows them to express their views on the future of Bitcoin prices. But they don't actually have to buy the Bitcoin themselves. There's still a lot of friction, I think, in the system around actual buying and selling of Bitcoin. But I also would say that it does make that asset class more accessible to retail. So the need for investor protection is as strong as it always has been. And I think here, with in terms of anti-fin crime, this is more the broader banking system, using cryptocurrencies for payment, using government fiat for payment. The criminals use whatever is available to them. So the banks need to be able to leverage the same amount of technology to be able to protect the system as well.
Now, Adina, if an investor hadn't been paying attention the past few years, they might tune in and say, why is the CEO of the Nasdaq talking about financial fraud? Well, it's because you've changed the company in a lot of ways, including with a huge acquisition last year, Adenza for $10.5 billion, which you closed on November 1st, if I'm not mistaken. What is Nasdaq now? How should investors be thinking about the company?
Yeah, we really have transformed to be a global technology company that serves the financial system. And of course, our markets are our foundation, and they're extremely technologically driven, right? They're very advanced technology in itself. In fact, we have our first SEC-approved AI order type that we're launching this quarter. So
what does that mean?
It means that it's an order type that factors in like about 150 different factors every second to determine the price at which, or the timer, the speed at which certain orders should be executed to maximize the fill rate. It's a very esoteric rule, order type, but it shows that innovation is very, very alive inside the markets. But at the same time, we've been able to develop really strong relationships across corporates, investors, banks and brokers, and other exchanges. So we now have become a technology provider to all of our clients, helping them navigate the markets with transparency tools, helping them be markets with our capital markets technology, and helping them manage risk and the regulatory obligations with the Adenza suite, which is Calypso and Axiom, as well as with our anti-financial crime capabilities.
Is this the year where we get a lot of AI companies that are private now come to market via the Nasdaq?
I think that, well, we hope they come to market via Nasdaq. I do think that AI-driven companies, AI-enabled companies, and AI companies themselves, those companies that can really help transform business, I think that those are the types of companies you'll see more and more of coming out into the public markets. Very exciting time, I have to say, because every company can benefit from this next generation of technology. I think you can look at every industry, and Gen AI has applicability. So companies that help unlock that potential are going to be, I think, that companies that a lot of investors are looking for.
Yeah, definitely seems like there's demand. I wanted to turn to a couple of sort of ESG topics because this is something the Nasdaq has been out front on. You have board reporting requirements, or at least explain or reporting requirements, where boards by the end of the year have to have at least one diverse candidate, a woman or someone who identifies as female, or explain why they don't. You defeated a court challenge to that rule. There's been a backlash against some of this type of accountability, if you will. What do you think? Why did you guys decide to sort of fight it through here?
Yeah, I think we have to look at the genesis of the rule. The genesis really was that it was really an investor-driven request from investors. You know, they had been for years talking to us about disclosures around board composition as being one of the factors that they use in helping them understand the company. And for certain investors, they have certain, whether it's certain investment themes or just an understanding of the composition of the board is helpful. We as NASDAQ, we are one of several gatekeepers to the public markets. So we look at governance as part of our listing review. But the fact of the matter is what we're really trying to do is provide investors with a very simple tool that enables them very quickly and easily to understand the composition of a board. And then to the extent that companies are looking to diversify their boards, they have at least one female person who self-represents themselves as female, one person who self-represents themselves as a minority, or the board can explain, or the company can explain why they don't. And they could have lots of reasons for that. They could have chosen that they wanted other areas of expertise or other things to fill in the needs of their board. But this gives investors the opportunity to understand the company better and do it in a way that's comparable across companies. And I think that that's really what it was meant to do.
Yeah.
Isn't a diverse board, diverse thinking the way to go? Doesn't that make for a better company? And are you surprised that these discussions or this backlash against DEI is even happening?
Well, I think diversity comes in all forms. So our view is that boards should represent a diversity of expertise, a diversity of background. You should look at your own clients and say, does our board represent the people we serve? Then at the same time, it should also different experiences. And I'm always looking for really exciting people to serve on our board, and people with the right experience, the right background, and someone who also has, is representative of the people that we serve as clients and the people we serve internally as employees. And I can tell you, it makes for better board discussions. It makes it so that I do feel like NASDAQ, because of all of the efforts we've had around really general inclusion across the company, and including our board, has made us a better company.
Fascinating discussion. Good to see you here on the ground at the World Economic Forum. NASDAQ CEO Adena Friedman. We'll see you back in New York City.
Great. Thank you, guys. Thanks very much.
Our thanks to our team out in Davos for that. Now we've got the latest numbers for the CME FedWatch Tool showing investor bets placing roughly 50% chance of Fed cuts coming in March. That is down from 67% last week and 71% about a month ago. Now as cuts come into question, investors becoming more wary of interest rate sensitive sectors. So for more on this, we're going to bring in our own Josh Schaefer. And Josh, we were just talking about this, but those traditional plays that tend to perform well or badly when interest rate hikes are higher, that's not necessarily playing out how it does historically.
So we've kind of had the reverse of the rally that we had over the last 2 months, right? When you take a look at kind of the action that we've seen in the market to start 24, when you just think broadly, it was small caps are ripping, right? Financials are ripping. Utilities are going up, real estate's going up. We'll just take a look at the market action today alone as we're thinking about people sort of coming back on those March rate cuts. Maybe the rate cuts come later, maybe we don't get as many cuts. You've got utilities down almost 2% and real estate almost down 2%, the two biggest laggards in the S&P 500 today. And it just seems like overall we're seeing people sort of step off those bets. Now, one interesting thing to point out with that, though, is as we're stepping off the rate cut bets in March, it comes with relatively good economic data. Right. The GDP Now forecast coming out today after retail sales projecting 2.4% GDP growth. You can see how it's moved up over the last couple of weeks there. And I thought Neil Dutta over at Renaissance Macro had a really good point with that. Well, if we're having rates move on good data, that's overall a good thing for stocks in the long run, right? Because good data would mean good earnings, and good earnings would mean good things for stocks. So it sort of gets to the fact that overall, maybe we just need to wait a little bit.
Yeah.
Like maybe the trade's still there. It's just we got a little bit over our skis, and now we have to kind of just let the dust settle and see where it goes.
How much do you think, Josh, this is, and we've talked about this, just folks kind of trimming some of their winners here? Because we've had strategists come on and say, listen, I like small caps, I still like small caps, but I'm booking some of my profits.
Yeah, no, definitely. I talked to Keith Lerner over at Truist a little while ago, and he said when you have markets rip the way they did to end the year, you have to expect a little bit of choppiness at some point. It's going to happen. But he had highlighted at the beginning of January, he said he's still standing by the call now, if you wanted to buy small caps as they were sort of rising at the end of the year, well, now might be your time to buy them, right? Because they're well off the highs that we saw at the end of December. If you look at the Russell 2000 over the last 3 months, we're basically back to where we were right before that Fed meeting. Right before Powell said, all right, go buy the soft landing stocks. We basically have the Russell 2000 back at that level, and he pointed to now as kind of a key point for that narrative. If we're going back to those levels, we know a little bit of technical analysis, we love to test those levels, right? Do we go lower or do we bounce back up? And so that's going to be a key thing to watch, I think, in the next couple of weeks, guys, as we get towards some of these moving averages, is there people looking to buy the Russell as it comes back down, buy small caps, buy some of those interest rate sensitive sectors, or is no one looking to buy it and we keep selling and the narrative shifts a little bit. But for now, narrative not changed yet. Just, we're waiting. We're waiting to see if the narrative
I love
changes.
in all the notes that we get, Josh, everything says the narrative's not changing, but also we think maybe the Fed is not going to cut rates when we say they are, so it kind of is
There's always
changing.
uncertainty, right? There's always uncertainty.
Waiting more data, as Jay Powell would say. Josh, thank you so much. Really appreciate your reporting on that. Now, coming up, we're going to have the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Still seeing some red on your screen. Stay tuned for more. That is your closing bell on Wall Street. We're going to do a quick check of the markets as we head into the close in a couple of seconds here. It looks like we are closing the day, no surprise here, in the red. Just seeing how these names are playing out. Your Dow Jones Industrial down 0.2%. The S&P down by 0.5%. Your Nasdaq is your biggest laggard at around 0.6% on the close. But pairing earlier losses, it was hovering around 7% throughout the day. When I look at some of the biggest laggards and in terms of the members within the S&P 500 specifically, as my terminal loads here, we see that Johnson Controls International was the top performer, followed by PayPal today. Also Smucker's in those top performers today. In terms of the laggards, some of those interest rate sensitive names that Josh was mentioning, Enphase Energy and Albemarle Corporation, also among the worst performers on the day, Josh.
You know what else ended the day in the red, Madison? Tesla.
Big one.
Shares sliding as the company slashes prices across Europe for its Model Y vehicles. Is coming after already cutting prices in China. So listen, we know Elon Musk has made it very clear he is willing to play the volume game, even at the expense of margins. If you're a Tesla investor, you're well aware of this. So Tesla cutting prices in Germany. It sounds like, Madison, for 2 versions of its Model Y, and that follows China, where Tesla cut the price of its entry-level Model Y and lowered the Model Y starting price as well.
Yeah, you have to wonder, if you are someone who is interested in buying a Tesla, why would you not wait for them to continue to cut prices? And that's what some folks on the street are saying today. Are they training the consumer to wait for a better deal? Also, an interesting note from Bank of America earlier this morning. You know, Josh, I've been obsessed with what's going on in the Red Sea and the potential impact. The only company in their coverage that has announced disruptions from vessels rerouting is Tesla. Tesla expected to halt production at its Berlin facility from late Jan to early Feb. They expect other companies with a large footprint in Europe could be negatively affected, not expecting huge downside, but it could be a temporary disruptor. So I think that's interesting to watch with this name, particularly as so many investors are bullish on Tesla. You have to consider some of those geopolitical risks to come this year, Josh.
Yeah, by the way, did you see that piece in the New York Times today? Kind of talking about how batteries for EVs can be less efficient, have shorter range when it gets very, very cold out. They were kind of profiling, talking to these EV fans in Chicago who are dealing with all these headaches right now, right? They've got like depleted batteries and long lines at the charging stations. It was an interesting piece. Just, you know, we talk about how consumer demand for EVs is kind of waning, at least here in North America. It was a good piece to read.
Yeah, it's not as easy as you might think, at least when you are talking from the perspective of Hertz, for example, selling off 20,000 of their EV fleet because of the concerns from consumers, maybe overestimating some of that demand. Another auto stock that we're taking a look at here is Ford. Shares of that automaker sliding after UBS downgraded the stock to neutral. They're citing limited upside to expectations, and their price target for that name is at $12. They said they see more potential for earnings upside at peer GM. They said they do like the CEO's vision and direction, but it could take a number of years for those benefits, the benefits of those plans, to be realized. You're seeing that stock down over the past couple of months and in the past couple of days as well. Interesting to note, Josh, they say that the UAW deal cost Ford more than they originally thought, and that has been coming up since that deal happened. And I think that is a story that's going to kind of be hovering over their shoulder for some time into the new year.
Yeah, in terms of what the analyst likes, by the way, he says he sees the potential for more earnings upside at GM.
Yep.
So in terms of names that he still likes, that's what he's telling his clients. If you look at Ford, since early November, Madison, the stock's up about 12%, though still down more than 10% over the past year. It is interesting you're seeing these downgrades for the car makers, even as rates are, you know, set to decline here. They've got this new labor deal in place, but for some on the street, valuation just doesn't look attractive at these levels.
Yeah, but it's still interesting. I know you love to look at this. We've got 43% of analysts have a buy on this name, 46% have a hold. So it's seen some mixed picture there from the analyst recommendations.
Sure. All right, let's get a final one here. A check on JetBlue. Shares of JetBlue and Spirit Airlines continuing to fall after a federal judge blocked JetBlue's $3.8 billion acquisition of Spirit Airlines on Tuesday. So we know, Madison, the federal judge stepped in here, blocked the acquisition, and kind of what does this mean for JetBlue is what I think investors are still trying to figure out, and also what it means for JetBlue's new CEO, remember, who takes over, I think it's just next month. We did speak to Elaine Becker over at TD Cowen about this. Remember, she expects JetBlue to kind of consider placing orders for aircraft so it can grow organically, though she told us that's going to take years to do versus what Spirit could have done with them much more quickly.
Well, and there's a potential read-through here outside of these two names to Alaska's proposed $1.9 billion acquisition of Hawaiian Holdings. Will that go through, given that this deal did not? A judge blocking that merger again on antitrust grounds. Hawaiian shares dropped a little over 3% today after declining yesterday on this news as well. The market pricing in about a 65% of this transaction going through. That was at about 70% before the news broke about JetBlue and Spirit yesterday. And it's interesting to see the market kind of pricing in less of a chance of that that deal going through because they're very similar. So you have to wonder what Alaska and Hawaiian executives are going to do with this deal moving forward.
Listen, the Biden administration has been aggressive here, moving in. If it's a deal that it thinks could harm consumers, they take action.
Absolutely.
For sure. Meanwhile, China growth data for the fourth quarter missing market estimates, and that's weighing on Chinese stocks for the full year. The nation's economy grew at 5.2% rate last year, hitting the government's official growth target. Joining us now is Brendan Ahern, CraneShares Chief Investment Officer. Brendan, it's great to see you. So let me just get your take on this economic data from China that we got here. GDP expands 5.2% in Q4 and for the year. The Journal noted an interesting stat here that actually, if you look at the Chinese economy, expanded last year at the slowest annual rate since 1990. Just interested, Brendan, let me get your take on that data and how you see the Chinese economy evolving in 2024.
Yeah, they saw opportunity, Josh. Yeah, the numbers were good, not great, not bad. I mean, some of the estimates in terms of Q4 GDP were a little light for the year. To your point, they met. So it shows that China's economy is coming back incrementally after the post-zero COVID crisis, which has really weighed on consumption trends in China. But it is coming back. It's just coming back slowly, incrementally, with the government kind of giving little nudges of support, but no policy bazooka, no free checks in the mail, no modern monetary theory. And that's left investors a little bit underwhelmed. They'd like to see a little more support.
Well, it's interesting to me, Brendan, you sound a little bit more positive on the China story than I had anticipated. And I'm curious, what do you think investors are missing when they're talking about timing the bottom in China? What upside are we potentially missing here?
Yeah, it's a great point. I think it's been really hard to catch a little bit of what's been a falling knife, as well as the U.S. equities have really been the only game in town in terms of global equities, in terms of U.S. stocks have vastly outperformed. So we're recommending investors volatility, adjust to position, potentially dollar cost average, maybe using overlay strategies such as options or structured products that can provide some level of principal protection or buffering, because we know this market is going to come back, and when it comes back, it tends to come back in a very dramatic fashion. It just market timing has been really, really difficult.
Yeah, nowhere to go but up, it sounds like. I'm curious, in the ETF space, would you say that the globally diversified ETF is still the move for investors, given that dynamic that you mentioned, where U.S.-centric stocks, the S&P 500, is performing so well compared to the MSCI?
Yeah, I mean, listen, over the last 14 years, the S&P 500 is up well over 800%. Non-U.S. equities, as measured by MSCI's All Country World ex-U.S., is not even up 1/3. So I think ultimately investors need to be aware that the next decade might not look like the last decade. And we just feel like 14 years, 56 times of opening up that quarterly statement, your non-U.S. equities underperform again. People are just throwing in the towel. And that reminds me a lot of what people felt about U.S. equities in March of 2009.
And Brendan, I'm interested, broadly speaking, when you look at these U.S.-listed Chinese names, Brendan, does valuation look compelling to you, or no, you think analysts are going to be, trimming their earnings estimates?
I think, self-serving and highly biased, we manage KWEB, the China Internet ETF, one of the largest China ETFs. Listen, with Amazon's market cap, you can buy all 31 companies in KWEB and still have $400 billion in cash left over. And that's despite Amazon having less revenue, cash flow, net income, EPS. So we think it has reached such an extreme point. It's laughable, right? The question is, what's the catalyst to get people back in? And I think potentially if we see the Fed cut, you might see the dollar start to roll over, which makes U.S. stocks a little bit less appealing to some of these foreign investors.
You mentioned KWEB, and I'm curious, you've got Alibaba in there, JD.com, some of the names that we were talking about earlier in our show that are struggling today off of that China economic data. What is the catalyst for upside on those names that's going to drive that ETF forward?
Yeah, I mean, I think there's a point where these companies themselves are the only believers in the stock, maybe besides myself. They're buying back stock in a very significant way. Alibaba spent billions of dollars buying back stock last year. Tencent files for their buyback every day. Meituan just started buying back the first time ever. So I think one is, at some point, fundamentals do matter, and we see other investors come back in. At the same time, there are some structural issues that we reported about today, that where Hong Kong is a big kind of structured product market, that when the indexes hit big round numbers, a lot of these products have to be unwound. It's forced redemptions, and in absence of buyers, that's causing the market to just to fall. So we think potentially the regulator, the exchange, should intervene. Something we actually saw take place in South Korea in November, where they actually banned short selling. So we think there's the potential for some sort of intervention to try to keep this market from kind of cascading downward, something that we've seen over the last 2 weeks.
Well, and that's exactly what I'm curious about when you look at the property market. How is China going to avoid sort of a Lehman Brothers moment? I think back to Country Garden missing their bond payment back in August. What do you think needs to be done based on the conversations you've had on the ground in China for the country to avoid that?
Yeah, and being in China in December, that was one of my questions is this China's Lehman moment? And the view is in China that it's widely recognized that the U.S. Federal Reserve allowing Lehman to go bankrupt is the greatest error ever by a central banker, because it created a financial crisis. And why would the Chinese government, Chinese financial regulators, allow one of these distressed players create an economic crisis? So it's receiving a lot of attention. I think it's important to recognize the December property sales was very disappointing. They just did a new trillion RMB, several $100 billion US, to support the real estate sector. They just announced that last week. So we haven't seen the effect of that. So we're going to see a lot more policy support on real estate based on a very, very bad number in December, as reported overnight.
And Brendan, I want to get you out of here on this. We talked about the economy and valuation, Brendan, but we didn't touch on geopolitics, and I am interested this tension between Washington and Beijing, Brendan. It's running hot. I mean, honestly, it seems like the one thing that maybe Republicans and Democrats actually agree on is their concern about China. How do you think that shapes and plays into investor sentiment?
Well, I think it certainly kept a lot of investors on the sidelines, and the main worry, Josh, if you're worried about China invading Taiwan or U.S.-China geopolitical, the stocks you should be worried about are the largest companies in the U.S. Apple does mid-teens revenue in China. Tesla, 25% of their revenues in China. ExxonMobil, 12%. Nike, Starbucks, Boeing. These economies are highly intertwined, and I think we're reaching a level where some of the political rhetoric out of Washington, D.C. threatens U.S. corporate interests in China, where they've done very, very well. I think the Biden administration is trying to tone down the rhetoric. Obviously, they don't control Congress.
Brendan, really appreciate you joining us for your insights on China. That was Brendan Ahern. Thank you so much. Now, coming up, we've got a possible new lawsuit in the government's battle against big tech. This time, Apple is the target. We'll have the details for you ahead.
Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. The Consumer Financial Protection Bureau released a long-awaited proposal today to rein in overdraft fees banks charge when a customer overdraws their account. The rule would cap fees anywhere between $3 to $14 compared with $35 on average now. For more on this, I want to welcome into the program CFPB Director Rohit Chopra. Director Chopra, thanks so much for joining me. It's great to see you.
Great to be with you.
You proposed capping overdraft fees for banks with $10 billion in assets or more in the range of $3 to $14 compared with $35 on average currently. How do you expect that this new rule could impact overdraft protection for consumers? And how much could consumers save on this rule?
Well, what we've seen when it comes to overdraft in recent years is a lot of abuse. It used to be a real convenience back in the day when you mailed a check and it took a few days to get there. But over time, as debit cards became ubiquitous, these overdraft fees turned into a billion-dollar bonanza. We have caught so many large banks engaged in illegal overdraft abuses. So what we're doing is we're looking to close a longstanding loophole that allows large banks to sidestep the consumer protections that are available with other loans like credit cards. Banks will still be able to make money, but they'll need to be upfront with it, and they'll need to be fair. We do anticipate that this will save the average family that experiences overdraft around $150 a year. I think at the end of the day, this is going to make the market more competitive, more fair, and really in the best interest of everyone.
To your point, Director Chopra, banks stand to lose billions of dollars on this. Do you worry that banks will try to make up for that lost revenue by trying to charge higher fees to consumers for other banking products or try to dial back availability of banking products like overdraft protection?
Well, trust me, banks will always look to find profits everywhere they can. But here's what we found when it comes to reining in abuses. Back in the day when there were new credit card reforms, we did not see a massive reduction in availability or any of the other predictions that the bank lobby put out there. We think what we've done is quite reasonable today. We're going to be collecting public input before finalizing it. We still think that there will be plenty of availability of credit and that people will be empowered to manage their overdraft loans more effectively.
And Director Chopra, what other fees can we expect the CFPB to propose going forward?
Well, we've looked hard at a number of places where financial firms are seeking to build a business model when their customers fail. So we've looked at certain credit card penalty fees. We've looked at non-sufficient funds fees, where we even caught Bank of America double dipping and charging multiple fees per incident. We also have been looking at all sorts of other customer service junk fees and have made it clear that there are certain places where it's just illegal to charge them. We even found a paper statement fee where the bank didn't even print it out or mail it. The results, I think, will ultimately be billions of dollars back in consumers' pockets.
Switching gears, the comment period for the Basel III proposed capital requirements ended yesterday. We've already heard from two Fed officials who have proposed major revisions to the rule in line from what we are seeing from comments that have come in already. What is your impression on what revisions could be made and what could you support?
Well, we're going to look at all of the input we're receiving, but here's a real core piece. A lot of the biggest financial firms, sure, they don't want to hold more capital, but guess what? The public doesn't want to bail them out anymore. We have seen some blockbuster quarterly earnings results, big numbers from JP Morgan Chase, Goldman. Many of them will be able to shore up their capital position using their earnings, using some of the existing assets that they have. So we're going to look, but I have to tell you, I don't want to be in a world where we keep bailing out the largest financial institutions on the planet. When they take risks, it should be their shareholders and executives who lose, not the public who bears risk of a financial crisis.
And speaking of comment periods ending, last week the comment period ended for a rule that you, the CFPB, proposed to regulate big tech payment systems like Apple Pay and Venmo, the same as the nation's largest banks. My question to you there is, big tech has said that this has gone too far. They'd like to see the rule reproposed. Are you considering making any changes to that rule? And when could we see a final rule on this?
Well, we're going to look at every piece of input we receive, but I guess what I'm wondering is the rule we've proposed doesn't put any new substantive regulation or obligations. It just allows us to take a closer look at their operations. If big tech companies are following the law, they should have nothing to fear about it. The reality is that there are now billions of dollars in payments being trafficked on Apple Pay, Venmo, so many other digital payment apps. They need to grow their business fairly and not use regulatory arbitrage. So Jennifer, I really want to make sure that consumers, they have their protections under federal law are being honored regardless if they're working through a bank or through a big tech company.
Well, we'll have to leave the conversation there. Director Chopra, thank you so much, as always, for your insight. So appreciate it. Hope to see you soon.
Great to see you, Jennifer.
That CFPB Director Rohit Chopra. Maddie, I'll send it back to you in New York.
Jennifer, thank you so much for that fantastic conversation. Now we're going to transition over to Apple. Apple facing another legal setback over its patent dispute with Massimo over its watch. The federal appeals court refusing to grant Apple a longer pause on the watch import ban. Dan Howley has the latest for us as always. And Dan, thanks for joining us on this. What does this mean for Apple? What do you anticipate the response from the company here?
Yeah, it looks like they're going to have to pull the Apple Watch again from store shelves in its online store in the U.S. At least as far as the Apple Series 9 goes and the Apple Watch Ultra go, the Apple Watch SE will continue to be on sale. They had to do this originally just ahead of the holidays because of the issues that they're having with Massimo and the blood oxygen sensor. Then there was a chance for them to continue selling it, but now it looks like that appeal for them to extend that hold on the ban is now denied, so they'll have to once again pull them. Overall for Apple, it means that they're going to have to somehow come up with a way to remove the blood oxygen sensor. Apparently they have something in the works, but it just isn't available right this moment. And so, you know, if they do have to pull them tomorrow, or when they do pull them tomorrow, they're not going to have any new Apple Watches on the market. And that doesn't mean that, you know, you can't go to Best Buy or Amazon or any of those places and buy one. You sure can. The issue is the import then at that point. You know, what happens if Apple tries to import more or if other companies try to import more. So, you know, this is going to continue to be a problem for Apple until this whole blood oxygen sensor issue is sorted out. And we'll have to see if eventually they do start selling the Series 9 and Ultra without the feature completely.
And Dan, that's one issue facing Apple. And then another is we're hearing these reports that Apple could be facing an antitrust trial, perhaps as soon as March. What are you hearing on that front?
Yeah, this is a kind of a continuation of a earlier story that we had heard about Apple kind of facing this potential showdown with the DOJ. This one report is coming from Bloomberg about the March date. But really what's happening is, you know, the DOJ has been looking at Apple, their App Store practices, their software and hardware practices for some time, whether or not they exclude competitors from using their products, and if that hurts competition in a way that would kind of rise to illegal in terms of antitrust laws. So, you know, there's the concerns over whether or not they block the ability for companies to use, for instance, services like Apple Pay or the ability to access Apple Pay hardware. The same with Find My. These are things that have come up quite regularly. There's also critics like Spotify and Tile who can complain about Apple blocking them out or making things harder for them. So this is something that's been going on for quite some time, and it looks like now the DOJ may end up filing suit, although they haven't, according to this report, they haven't finalized any decision yet.
Dan, thanks so much for walking us through that. And I should mention Apple down about 0.5% after the close heading into tomorrow's market. Really appreciate you joining us on All Things Apple always. Now, coming up, we've got more from the 2024 World Economic Forum in Davos. We've got the Carlyle Group co-founder David Rubenstein. He spoke with Brian Sozzi and Julie Hyman about a potential Trump presidency, higher education, and his possible purchase of the Baltimore Orioles. We're going to have more on that after the break.
Here at the World Economic Forum in Davos, we've been talking on the sidelines with folks about the upcoming U.S. presidential election and the effect it might have on U.S. markets, on the global economy, certainly the U.S.'s dealings with other countries. One of the folks we want to talk to about that is David Rubenstein, co-founder of the Carlyle Group, which has $382 billion in assets under management. So putting a lot of that money to work in markets around the globe. David, thank you for being here.
My pleasure. Thank you for having me.
And of course, we should mention you're a TV host, fellow TV host as well. We would be remiss if we didn't mention that.
The highest calling of mankind, being a TV host, right?
We think so. So what effect do you think this election is going to have on markets? The last one was hard to predict, but can we predict anything about this one?
Well, tell me who the president's going to be and who the Congress is going to be, and I'll tell you what the impact will be, probably. So look, if the Republicans win the White House and both houses of Congress, clearly there's going to be a more pro-business approach. if the Democrats win both houses and the presidency, probably be not as pro-business, I guess. But what the economy statistics show is that the economy actually does the best when you have divided government. Now that wouldn't be logical because the government is fighting with each other. But actually, if you go back over the last 50 years or so, the S&P 500 or the equivalent go up more when you have divided government. And it's not easy to explain why that is, but maybe it's a checks and balance kind of thing. If the President of the United States is Donald Trump, future, obviously a lot of CEOs will be happy. They won't say so publicly, but he will probably reduce taxes, reduce regulation. If Joe Biden is elected president again, I think some business people would say we're going to have more regulation, very difficult to get antitrust approval for things. But in the end, you adapt to things. What business people are good at is adapting. Just tell them what the rules are and they'll try to figure out how to deal with it. So it's often difficult to predict where the markets are going to go, though, because interest rates are going to drive it more than anything else, and that's pretty much apolitical.
Are you surprised that Trump still has this support for another presidency in this country?
I am surprised. The day after he lost the last election, I was on the television show. And that morning, I said, I think he might run again, and people laughed at me. But the truth is, he never gave up the idea of running again. He thinks he won the last time. He wants to prove that he deserves to be president again. I'd say the most amazing story in American politics over the last 50 years or so, other than the fact that a black man was elected president once, or twice, Barack Obama, is that Donald Trump came from oblivion in terms of politics, was elected president, and now has a chance to be elected again after being nominated for the third time in a row by the Republican Party. No other Republican ever has been nominated 3 times in a row by its party.
Even though he is a Republican, obviously he's not a very traditional Republican, right? We talked about the effect on the markets, and I think we think equity markets. What about capital markets, particularly globally? I mean, we've been told that European leaders, for example, are quite concerned about a Trump presidency. Is there going to be effect on capital markets as well?
The Europeans never liked Donald Trump. I don't think they're going to like him if he comes back as president again. I think he has a lot of support in other parts of the world. I'm not his advocate, but I would say that some parts of the Middle East he was pretty popular. I think he was reasonably popular in some parts of the Far East, Japan as an example. But I just think markets will adapt. I think the biggest issue we're going to have to deal with if Trump is president again is just living through some of the dysfunction the government has with Congress, the Congress's inability to get things done. That's the biggest problem we have. It's not the president so much right now, but the Congress can't seem to pass appropriation bills or keep the government going, and that's a big problem.
Is the business community prepared to work with him? Or will they fear being mentioned on one of his social media accounts and maybe they don't want to get entangled with the administration?
It's too early to say. Obviously, very few business people do not want to help the President of the United States when they're asked to do so. So if he asks them to do so, I suspect if he wins, he'll probably win by a margin sufficient such that people would say, I want to help the President of the United States, I want to help my country. But it's too early to say. And remember, Joe Biden has a reasonably good chance of getting elected too. Incumbents tend to get elected more than they get defeated, and he's got a reasonable chance. So it's too early to say. If you were to predict who the next President of the United States is going to be 10 months in advance, the last 10 presidential elections, you'd be wrong every time. You wouldn't have predicted 10 months in advance Barack Obama, Donald Trump, you just wouldn't have predicted it, or Joe Biden 10 months in advance. So it's just too early to say. We have to figure out what the health is of these candidates, what other geopolitical events take place that might hurt or help one of the candidates. It's just too early to say.
All right, David, I want to switch gears, and this might be a tricky one. I don't know how much you can say. Are you going to own our Baltimore Orioles? What you can give us any kind of something on that?
Are you from Baltimore?
I'm from Baltimore.
There's some things I can't talk about yet, but I've read about that, but I don't know. We'll see.
You read about that. Okay, fair enough. We will stay tuned and hopefully have you back to talk about that. Something else, again, I don't know how much you can say about this. I know that you didn't go to Harvard, but you're involved with Harvard, particularly the Harvard Corporation, which is the parent.
I was one until July 1 of this year.
Right, exactly. Okay. What do you make of what's been going on, not just at Harvard, but in higher education more broadly? As you know, there's a lot of concern over, in particular, anti-Semitism, and just sort of DEI initiatives on campuses. What do you think?
Well, what happens on university campuses reflects what goes on in the country generally. So it's not as if certain things happen only on university campuses, they're not happening elsewhere. Currently, I'm the chairman of the board of the University of Chicago, and we have a different policy than many other universities on public policy kind of statements. We don't issue public policy statements on any issues, so we've dodged certain things that maybe other universities weren't able to dodge. But we do have, issues of making certain everybody has the right to speak and try to not have people prohibit other people from saying what they want to say, within reason, obviously. You don't want to have people encouraging violence and things like that. But universities reflect the society that they're in. And so in the late 1960s, for example, we had a lot of protests against the Vietnam War, but that reflected what went on in society. So right now you have a lot of concern about anti-Semitism in the United States, as there should be, and that is reflected sometimes in college campuses too.
Why do you think DEI initiatives have come under so much scrutiny? I think to the average person out there, this seems like good for business and good for the country.
The United States in 1960 was a country that was essentially a white country. 90% of the people that voted in that 1960 election were white. 8% were black and the rest were other minorities. The country's different. And people who are white, maybe not educated, or not, they feel globalization has passed them by, there's a lot of resentment towards affirmative action, DEI, things like that. And I think Donald Trump has played to that somewhat. I think that there's a lot of concern about DEI in some circles, and maybe it went too far in certain areas, but I think it's probably going to tilt back. Nothing goes forever without making some changes. So I think DEI is a good thing, but in the end, some people have resented it, and some people feel that what the Supreme Court said about affirmative action in college admissions is probably something that should be reflected in other parts of society as well. In other words, not so much affirmative action. That isn't my view, but that's the view of many other people.
And just quickly to end here, some folks in the financial world have said, I'm not going to hire someone who comes from this university who's said this particular thing. Well, obviously, you have a lot of employees at Carlyle. How do you think about who are coming from elite universities? How do you think about that?
As a general rule of thumb, trying to penalize people for the rest of their life for what they might have said or not said while they were in college is probably not a good thing to do. So what did you do in college that you might not want people to know about? What did you do in college? Okay.
Yeah, exactly.
So everybody probably did something in college they were probably not proud of, and so I think you shouldn't penalize somebody for the rest of their life by something that happened in college that they might have done when they were relatively less mature than they are when they're going to be an employee.
David Rubenstein, thanks so much.
Thank you.
Good to see you.
And going back to the inflation story here, because inflation's decline over the last year is benefiting America's lowest earners. That's according to new research from Oxford Economics. Josh Schaefer here again with us with the details. And Josh, I'm really glad that you're bringing us this story because we get into the whole good news is bad news conversation because we're looking at the Fed in particular. But for people who are experiencing these price hikes, it's just good news.
Wage growth is good news,
Yeah.
right? For American consumers, you want to be making more money, right? And that's always helpful. And this Oxford Economics research was very interesting to me because it points out where we're seeing the biggest wage growth right now. We're talking about real wage growth here. So real wage growth is the wage growth that we see from data from someone like the BLS minus inflation. So what happens after you take out that inflation that we talk about a lot? And what you see in the graph from Oxford is that the lowest income earners right now are actually earning the most in terms of wage growth. So right now their wage growth is about 3%. You can see that's the purple line there, and the blue line is what highest income earners are earning for wage growth. They're at about 1%. So they're making a little bit less money, so you can see lower income consumers actually benefiting in terms of that, but really where they're benefiting too is where they're able to spend. So low income consumers, we know, spend most of their money on things like food and gas. Their money goes right back into the economy. Well, food and gas were some of the biggest drivers in CPI's fall downward in 2023, right? So economists sort of highlighting that inflation has actually helped them the most because that's where their money spends. And Josh, the other interesting part spinning this forward is low-income consumers, as I just said, spend the most of their paycheck back into the economy. So when you think about the consumer spending story into 2024, it is important to have low-income consumers making more than inflation because they're the people that get their money and they go to the store and they spend it. So when you're talking about all the companies and businesses that we talk about in the overall economy, you want these low-income earners to be able to earn enough to go to the grocery store and buy groceries, to go to the gas station, to go to different companies and be able to buy things. And that's what Oxford's pointing out in this note too, which is interesting. Maybe a boost for consumer spending or something that will keep it up coming into 24.
And when in this report, Josh, when they were talking about falling inflation, were they specifically talking about food and energy, and also how does rent, do they think, play into this?
Yeah, so rent's one of the ones that they highlight that they think is going to come a little bit more in 2024 too. So when you look at the CPI report that we just got for December, services is one thing that holds it up a lot, right? And also shelter. And so the shelter inflation that we've seen, while it's come down in other measures of rent. Some people don't love the CPI measurement of rent, but eventually what we're seeing is that's going to come down. So that's something too, because again, low-income earners, one of the major things they spend on is rent. So that's expected to come down in 2024 and is definitely something to watch in terms of them.
All right, Josh Schaefer, pulling double duty today, by the way.
I know.
Two reports.
I just love hanging out with you
one
guys.
Show. Well, I appreciate that.
The Fed.
I love that personal touch. Yeah, I really do. Josh Schaefer, thank you, sir. Coming up, Yahoo Finance's Brian Sozzi and Julie Hyman are at the 2024 World Economic Forum and are sitting down with the co-founder and CEO of Circle to discuss the crypto industry. Stay tuned for Yahoo Finance on the other side.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Unlike in the go-go crypto days of years past at Davos, where there was crypto signage everywhere, this year there is some signage. It's a little more limited. One of the companies that has a little space here and a sign is Circle, the stablecoin company. And joining us now is the CEO, Jeremy Allaire. Good to see you, Jeremy. Thanks for being here.
Thanks, Julie. Great to be here.
So we're at yet another interesting moment in crypto, among many. When you are here in Davos, what are the conversations you're having? What are the goals here? And kind of where are we in the global crypto arc, so to speak?
Sure. Well, for Circle, really since inception, our focus has been how do we take the traditional financial system, traditional money like dollars, and connect it to this technology, connect it to blockchains, and build new kinds of payment systems, value exchange systems built on top of that. So we've always had a little bit of a different approach, and I think the kinds of things that we're trying to accomplish here are also, as a result, a little bit different. So it's working with governments around the world, many of whom are putting in place stablecoin regulations as we speak this year. It's a big movement. Working with financial institutions who are increasingly getting involved in this industry in different ways. You see that reflected in some of the major names involved in some of the launches last week. And then, of course, I think the opportunity internationally is, how can digital dollars play a bigger and bigger role in humanitarian aid, in the effective use of remittances and international transactions. And so those are the things that kind of run at the core of what we do and a lot of the agenda that we have here at the forum.
You're the co-founder of Circle, and you're also a crypto shakeout survivor. At Davos, are you getting questions, Jeremy, how did you do this? Are you getting a lot more street cred because you have survived the crypto shakeout?
Well, I think we've always, tried to kind of go that trusted, transparent, compliant path, and I think, that's been core. And I think we've always had a reputation as a firm that sort of tried to do things the right way and work with regulators and others. And I think, through the turmoil of 2022 and parts of 2023, there are, I think, a lot of projects and a lot of companies that didn't have that as their DNA, and I think you saw some of the outcomes from that, whether they turned out to have financial fraud and they had no controls, or I think were out ahead of themselves in terms of financial crimes and other things. So, look, we've done things the right way. we've also focused on the non-speculative part of this, which is how do you take dollars, digitize them, and make them run on the internet using blockchain technology. And so our whole focus has not been what's going to be the next token that you're going to trade. It's really been on how do you make this a useful infrastructure, and I think that kind of infrastructure play is critical. I mean, I think the killer app of blockchains is without question stablecoins, and so we're part of that, that kind of evolution.
As a leader, let me just press back on that. How do you not get sucked into the hype?
Well, look, I take a very long-term perspective. I try and think about, what can the world look like over 5 years, 10 years, 15 years, and really just try and focus on what are the kinds of things we need to be doing now. What is the infrastructure, the partnerships, the technology, and yes, there have been things that have been flying fast here, there, and we've just sort of diligently focused on incrementally building what that is. And I think, at the end of the day, when you zoom out and you look at what we've been able to accomplish over 10 years, it's pretty extraordinary. And so I think, just staying long-term focused, looking at what's in front of you, taking those next steps, trying to do it, deliberately, allows one to not, be constantly, jarring back and forth over what the latest, hype is.
Speaking of next steps, you guys have filed for an IPO. I know there's only, not much you can say about it, but can you tell us why you've decided to go ahead with that particular step right now?
Yeah, I mean, I can't make specific comments about any regulatory filings or things like that. We have been very clear for a very long time that we want to build one of the most trusted, transparent, and compliant firms in our industry. And ultimately, we've said that becoming a U.S.-listed, publicly traded company is an important part of that. And so we are committed to that path, and we're committed to ultimately, being that. Can't comment on any specific filings and things like that, but I think it's important to have the kind of trust and transparency and compliance that comes with ultimately being a public company.
It's so interesting to me in crypto because there are so many ways, even though crypto sort of faithful or pure folks would like a world to exist just on crypto. There are so many places where crypto and fiat and crypto and the traditional TradFi intersect. And you guys are really a good example of that. You have USDC, but you have reserves. You're going public in the US, regular financial markets. Is that just how it's going to be? Do people just have to accept that they have to work together?
Well, I think for companies that are, trying to build products and technologies, whether they're regulated products or not, that kind of connect the existing financial system and this, then yes, absolutely, have to kind of go through that. Anyone who wants to be an intermediary and to handle customer money or conduct transactions that have risks of crime or other things, there are obligations, and you need to do that, and you need rigorous standards of audit and other things like that. So that is really vital. At the same time, the technology is the technology. And so, a technology like Bitcoin is truly decentralized. And so there will be, what I like to refer to as, these digital commodities, just like there's no government that issues oil or there's no government that issues gold. Digital commodities are a fact of life now. And I think the world has to figure out, okay, well, how do these digital commodities exist, and are there rules around who can buy them and sell them and the markets for them, and you see that with other commodities as well. So I think that's sort of emerging too.
Talk to the head of public policy over at Coinbase, and he stopped short at saying that crypto, or I believe he probably talked about Bitcoin, would rival the US dollar. Do you think we'll hit that day where the dollar's rivaled?
Look, I think the dollar is the world's reserve currency, and my own belief is that the U.S. can't take that for granted. We live in a world, we've seen dollar weaponization, we've seen balkanization, we see different geoeconomic blocks that are forming and want to form alternative payment systems. That's happening. I mean, that's widely discussed. And so if the United States wants the dollar to remain the predominant currency, then it needs to have a strategy for that. And the currency competition in the future is a technology competition. It is not just a monetary policy competition or who's able to repay their debts competition, which is sort of the basis of the dollar, but it's a technology competition. And there is a kind of digital currency space race, and the US needs to put in place the laws that allow for digital dollars to thrive and allow the private industry and regulated private markets to kind of grow. And so that's why we've been such advocates for dollar stablecoin laws, because it's actually part of how the US can win the digital currency space race. So cannot take it for granted. I think in 10 years, the currency regimes that have embraced this next wave of internet technology are actually going to be in a stronger place. And so I think to the question of whether a commodity money like gold or a digital commodity money like Bitcoin could play a larger role as a store of value or a reserve asset, I'm open-minded about that. I think that could grow over time.
Jeremy Allaire, thank you so much. Good to see you.
Great to see you. Thank you.
Coming up, what to watch tomorrow, we break down the stories you need to know to start your day.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
Just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Check out shares of Plug Power here. They are plunging in the after-hours trading. The company files for a $1 billion share offering. So the headlines here, Madison, files for possible offering of shares via B. Riley, and shares are taking a hit here. They're down about 16% in the after hours. Of course, this stock has been a mess for a while. It is actually down about 80% in the past 12 months. It's down about 40% just so far this year. You would think that would bake in a lot of bad news, but actually, if you look at analysts covering the name, most clearly don't think so, because they're still on the sidelines here, even after that kind of nosedive.
Yeah, it's interesting. This is another one of those companies impacted by higher interest rates. Those flatten utility prices, change metering net prices as well, and we're seeing that impact not just names like Plug Power, but also I'm thinking Enphase Energy, SunPower as well. That stock is not yet active, but down 79% in the last 12 months. And a reminder here just about what Plug Power does. Their focus is the development of hydrogen fuel cell systems that replace conventional batteries. So this is a climate-friendly play, but the demand is just not there. Interesting to note, though, the company's top customer is Amazon. That generated about 15% of its sales previously. So I'm curious to find out what strategy change happened at Amazon and how that read through to what we're seeing in terms of Plug Power's performance.
Yeah, we had seen some bulls moving to the sidelines. By the way, recently they talked about near-term uncertainty around financing, around gross margins. So you had seen some folks take down their rating heading into that news. Meanwhile, time now for What to Watch Thursday, January 18th, starting on housing. Housing starts and building permit numbers coming out in the morning. Housing starts expecting to fall, while economists forecasting a slight increase for building permits. This coming on the heels of strong builder sentiment today. Mortgage data also coming out in the afternoon. Rates have risen the last 2 weeks.
And turning over to jobs, new numbers on initial jobless claims. That's the government's report on the number of workers applying for unemployment benefits for the first time following job loss. That'll come out tomorrow morning. We're expecting to see an increase in claims from the previous week.
On the earnings front, we'll get more regional banks reporting throughout the day, including M&T Bank and Truist Financial, among others. We'll also keep an eye on Birkenstock. as it's reporting for the first time since going public last October.
And back over to the Fed. Atlanta Fed President Raphael Bostic speaking twice tomorrow. Investors obviously keeping a close eye on the Fed's comments as those March rate cuts and potentially June rate cuts still up in the air here.
All right, you want to drill down? Let's talk Birkenstock. Let's talk sandals.
No, let's talk Birkenstock. You know, I don't own any Birkenstocks.
Really?
I mean, it's absolutely shocking, and it's really embarrassing. I should.
Well, you know, I own
Birkenstocks.
two, so I'm making up for it.
That's great.
We're all good.
I have a knockoff pair, but yeah, I get
equals
to the
out.
news. Yeah.
Birkenstock reporting results tomorrow before the U.S. Open. This is, of course, the company's first earnings report post-IPO, of course, made its public debut, remember, late last year in October. There was kind of that trickle of IPOs it was part of. It was like Instacart and ARM, Birkenstock, Klaviyo. One question we talked a lot about is whether that trickle will actually turn into a stream this year. Right. Birkenstock tomorrow, yes, we did get that stronger expected retail sales report. Still below plenty of questions, Maddie, about the consumer, about the economy. So any color company gives us about 2024, I think that's going to be critical for investors.
Well, I think it'll be interesting given the really harsh IPO that Birkenstock had, right? That wasn't the best day for them. So I'm curious to see. Yeah. That was rough. So I'm curious to see how they're able to kind of get investors back in game with the company after that IPO was tough. And it seems like when I'm looking at the options pricing here, it seems like there's going to be some volatility heading into tomorrow's report coming out of Birkenstock there.
All right, we'll be watching.
Yep.
That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after closing bell.